Baiya International Group, ticker BIYA, is currently trading at 0.46 US dollars, representing a staggering intraday spike of 67.32%, up 19 cents on the day. When you see a move like that, a 67% gain in a single session, the immediate expectation is that you've found a rocket. The assumption is that some incredible company-altering news has just hit the wires. A buyout, a massive earnings beat, a major partnership. The reality of this 46-cent stock, however, is something far more complex and, frankly, far more dangerous than most retail investors will realize until it's too late. This 67% jump isn't a signal of a healthy, growing company. It is a symptom of a microcap stock in deep distress, a stock that was, just 2 weeks ago, announcing a desperate 25-for-1 reverse split just to keep itself from being delisted from the Nasdaq. What you are seeing today is not a fundamental re-rating. It is the chaotic, high-velocity movement of a highly speculative, low-float instrument. Let's establish the common ground. The general belief, fueled by platforms that list top movers, is that a stock rising this much, this fast, is an opportunity. Traders using the Robinhood app or the SoFi investing platform see green. They see momentum, and they see a low entry price. They think, it's only 46 cents. How much can I lose? This is the expectation, that you've caught a multi-bagger at the very beginning. But this expectation completely misses the reality of what BIYA actually is. The reality is that this company, which IPO'd in the US market only in March of 2025, is already failing. It received a Nasdaq non-compliance notice in October because its share price failed to stay above the required $1 minimum. The reality is that its earnings have been declining at a disastrous rate. It has less than a year of a cash runway, and its market cap is barely in the double-digit millions. And here's the most important part of the reality check, the part that many investors engaging in online investing completely miss. When you buy shares of BIYA, you are not buying a Chinese HR tech company. You are buying shares in a Cayman Islands holding company. BIYA, like many other U.S.-listed Chinese firms, operates on a variable interest entity, or VIE structure. This means the Cayman entity you can own has a set of contractual agreements with the actual operating company in China, Shenzhen Gongyuan Network Technology. This is not a trivial distinction. It's a massive, glaring risk. You have no direct ownership of the assets, the platform, or the revenue. You are betting on the stability of a legal contract that the Chinese government could invalidate at any moment, leaving investors with absolutely nothing. This isn't a risk you associate with Apple stock or even Nvidia stock. This is a unique and existential threat tied to this specific corporate structure. So why is it moving 67% today? The search for a press release or an 8K filing comes up empty. There is no earnings report. There is no new major contract. This is a critical red flag. The move is, in all likelihood, a technical one. This is a low float stock, meaning there aren't many shares available for public trading. It takes very little volume, perhaps a coordinated push on social media or in a trading-focused chat room to send the price flying. This is a classic microcap pump. And the volume, while likely high relative to its own average, is a drop in the ocean compared to a name like Tesla stock. These moves are designed to attract attention, to pull in FOMO, the fear of missing out, from those using self-investing tools. It's a game of musical chairs, and the 67% pop suggests the music is playing at full volume, but it will inevitably stop. The challenge for investors is to see past this noise. Let's look at the fundamental news that has come out recently, because it paints a picture of pure desperation. On September 26th, BIYA announced a definitive agreement to acquire Starfish Technology, a Web3 company. In July, it touted that Starfish's UpTop.meme platform had launched on Binance Alpha. This is a classic move from a failing company. Pivot to whatever the hottest, most speculative sector of the market is. The core business, the Chinese HR platform, is struggling. So what do? They bolt on a Web3 and meme platform. This is a narrative-driven gamble. an attempt to convince the market that they are now a high-growth tech play instead of a failing HR company with a dangerous corporate structure. This isn't an organic expansion, it's a Hail Mary pass. Think about the contrast. An investor putting their trust in Schwab Intelligent Portfolios or building a long-term plan with Fidelity Wealth Management is looking for stability, for proven business models, for actual profits. A serious institutional desk at Interactive Brokers would look at BIYA's financials, its cash burn, its Nasdaq non-compliance, and its VIE structure and immediately dismiss it. But for a day trader on Robinhood, the 67% gain is all that matters. This is the great disconnect in today's market. The investment help you'd get from a professional would be to stay away, while the help you get from a stock screener is to jump right in. Let's briefly talk about what the company was supposed to be before this Web3 pivot. The core business is its Gongyuan platform. This is a cloud-based SaaS-enabled system for flexible employment in China. It provides job matching, entrusted recruitment, project outsourcing, and labor dispatching services, primarily for the manufacturing sector. On paper, this sounds reasonable. China has a massive flexible workforce, but the financials don't lie. The company's earnings have reportedly declined by over 60% per year. The business model, whatever its merits, is not working or is not profitable. The recent first-half fiscal 2025 results from September 30th did not reverse this trend. This is the context for the pivot. The old business is failing, so they're trying to attach themselves to a new narrative. This leads us to the 25-for-1 reverse split announced on October 23rd. A reverse split is a cosmetic procedure. It takes 25 shares and consolidates them into one, multiplying the price by 25. This is done for one reason and one reason only: to artificially inflate the stock price back above the $1 minimum and regain Nasdaq compliance. It does not create any value. It does not fix the cash burn. It does not improve the HR platform. It does not make the Web3 pivot more likely to succeed. It is, in fact, a signal that the company's management sees no other path to staying listed. This is the real news, the news that was happening just before today's speculative pop. This 67% spike is a short-term frenzy directly contradicting the long-term, desperate reality of the company's position. So what happens from here? The future outlook has two starkly different paths, one based on the expectation of this 67% move, and one based on the reality of the fundamentals. The expectation is that this is the bottom, that the Web3 pivot will work, that up-top dot meme will capture the imagination of the market, and that this 46-cent stock is on its way to $1, $2, or $5. This is the story the short-term traders are telling themselves. The reality is that this pop is likely transient. It's a squeeze, a momentum trade that will burn out. The more probable scenario is that this volatility will attract short sellers, the shareholder vote will approve the reverse split, and the stock will be consolidated. After that, the price, now perhaps $11.50, 46 cents times 25, will likely resume its downward trend as the fundamental problems of cash burn and a failing business model reassert themselves. The biggest risk remains the VIE structure. If Chinese regulators ever decide to crack down on these, the stock goes to zero, and it won't matter if you bought on Fidelity or Robinhood. This is why understanding the difference between a good company and a hot stock is critical. Apple stock is a good company. Nvidia stock is a good company. They have real products, real profits, and real tangible assets. Baiya is, for today, a hot stock, but it is built on a foundation of sand. It's a Cayman-based holding company with a struggling core business, a Nasdaq delisting notice, and a desperate pivot to a meme platform, all wrapped up in a high-risk VIE structure. This is not a place for investment sites to recommend for your retirement. This is a vehicle for high-stakes speculation. When you see a stock like this, it's not time to look for investment help on how to buy. It's time to ask why it's moving. And in this case, the why is the most telling part of the story. Given this pivot, I want to know what you think. Comment below with a simple HR or Web3. Which business, if any, do you think has a future here? To summarize, we are watching Baiya International spike 67% to 46 cents. The expectation created by that number is one of explosive growth, a hidden gem being discovered by the market. The reality is that this is a non-compliant, cash-burning microcap VIE structured company just 2 weeks away from announcing a 25-for-1 reverse split to save itself from delisting. The move today is pure speculation, likely driven by low float and disconnected from any fundamental news. It's the perfect example of the tension between a market narrative and a business's underlying health. The narrative is a rocket ship. The reality is a ship taking on water, frantically trying to patch the holes with a new coat of Web3 paint. This isn't